Intel just reported earnings and the shares are down considerably in aftermarket trading, but I actually don't think the results are as bad as people think. And so I'm going to get into that in this first look. So as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Let's dive right into this one because in aftermarket trading, it looks like a train hit Intel. People are very upset at the results and the shares are down almost 10% in aftermarket trading. And so you can see that the shares were up a little bit today on anticipation of the earnings. And then, of course, after the earnings came down, the shares are down as of right now, approximately 10%. And, you know, we'll see how this people react on the security tomorrow. My suspicion is that it's going to open up less down than it currently is. So I don't think it's going to open at $27. However, there is cause for concern, and I'll get into that in a second, that could cause people to be very pessimistic in this environment and now start to trade this security much lower. And, you know, when it comes to being pessimistic in this environment, especially in the face of a consumer slowdown, I feel like I'm just beating a dead horse when I keep saying that, you know, when it comes to valuing these names out, you really need to be pessimistic. Otherwise, you're going to be surprised on the downside. And it looks like a lot of people have been surprised on the downside on this name, and they're going to open up to a bigger loss in their portfolio on this particular position tomorrow as a result of being a little bit too optimistic. And like I always say, don't fight the Fed, especially in this type of situation, and especially with the type of company that's very levered to the consumer. You know, most of their revenue, I think still greater than 50% of their revenue comes from that consumer market group. And so just diving into the results a little bit, so you can see that overall revenues are down 32% for the quarter, and you know, they had a loss in the quarter. So that's very interesting. And just moving into the results a little bit, you know, I was watching some YouTubers talk about this, and I would just say that you're absolutely crazy if you didn't expect a full year results to be challenged. And so, you know, notice that the client computer group is down 36% in the quarter, and the data center is down 33%. Now, this was a little bit of a surprise for the quarter. For the full year, I was actually expecting 15%. And actually, for the client computing group, I was actually expecting it to be down a little bit more than this. So, in fact, they actually outperformed what I was expecting. And I'll show you what the model looks like next. So you can see here's the model. So, you know, the client computing group came in at $31.7 billion. And, you know, here's my model unchanged because I just wanted to show you. So, you know, I was forecasting 2022 at $30.3 billion. So they actually came in a little bit higher. Am I the only one where the company actually outperformed my expectations on this segment? Because I think everyone else was predicting this to be much higher. And this is what I mean about optimism in this market. Why be optimistic? What's the point, man? Let the market come to you, man. Don't try and chase positions. And so, you know, although, you know, what do I know, right? I don't really know the chip space that well. I fully admit it. And so that's why I require such a large margin of safety. And it's also the reason why I build in such large amounts of conservatism into the models. And so the data center segment pretty much came in bang on with my 15% year over year decline at $22 billion. But of course, guys, you guys know that it's not the results that are impacting the investors and why people are trading this thing down. It's the guidance, which is freaking out investors. And so let's go into the guidance. So you can see this is what's scaring everyone. The company expects revenue for Q1 of 2023 to be $11 billion, or in between 10.5 to 11.5. So I just call that $11 billion. Compared to $18.4 billion in 2021. That's a 40% decline year over year. And they're not providing full year guidance, which is very unusual, but they are doing that because the market is just unpredictable right now. So this tells me that they've already seen results fall off a cliff for Q1 with the first, I'd say, 3 or 4 weeks of results. And they expect that that will continue at least for the first half of 2023. So 2023 is going to be a bloodbath. This is something that we were expecting already. However, I don't think very many people expected a 40% decline on the top line. I didn't even expect a 40% decline. I mean, this is just for one quarter. So, you know, I think overall, if you look at their modeling, they probably, they don't release their modeling, of course, right? But they probably expect overall revenues to maybe be down maybe 20% on the year. We'll see if they provide a little bit more color on that in the subsequent quarterly releases. And of course, one way to sort of get an idea of how they're modeling it internally and how they see the industry or how they see their results playing out for 2023, despite not providing us with guidance, is looking at their outlooks for the industry. And so notice that, they do expect volatility across all markets. They're seeing an inventory digestion, sell-in, which is well below the sell-through. And what that really means, and the way I'm interpreting that, is that retailers are reducing their inventory amounts at a rate that's greater than the amount of inventory that's being sold. Now, that might not necessarily be how to interpret that. You guys let me know if I misinterpret that. But essentially what I'm thinking is happening here is that there's an inventory glut in the retail market space right now. They want to get rid of the inventory glut so they're not purchasing more computers as a result. And in a consumer slowdown market, retailers generally try to reduce their amount of computer inventory. And so their inventory amounts are just declining as a result. And so you've had this heavy buying season, which was a year ago, and now you're having a very weak buying season. And so they're going to experience the impacts from that. And so ultimately, I just think that the inventory glut remains as the consumer slowdown continues. And, retailers are looking to reduce inventory by selling off more and more of it. And so, I would say that's all well and good in the short term, but don't get caught flat-footed on the negative emotions from the stock market gamblers in this environment. There could be a real buying opportunity here. I'll know more once I model through the year-end results, and I'll take a position on growth, and I'll notify the Patreons tonight when the model is updated. So if you are not on the Patreon, now's a good time to get on it at that lower tier, which is just $5 a month. I really believe that that's the best value on YouTube. And what'll happen is I'll let you guys know when the model is updated and give you a valuation, or at least what I think the company's valued at. You guys obviously are free to rebut that. But notice that I think long-term, they're right. PC usage will remain strong as the economy does reopen. And what was interesting is how quickly the server market declined. They do expect it to return to growth in the second half of 2023. However, I question how they're being impacted by competition with AMD and NVIDIA in this particular subsegment or in this particular segment. And so I'll dive into that in a little bit. And so just starting with the client computing group, you can see that they are telling you that there's lower revenue on PC demand softening and customer inventory reduction. So it's exactly what I thought it was. So, you have a slowing PC customer, and then you also have the retailers who are just buying less to try to bring their inventory levels down. And so, of course, both of that is having sort of like a two-tiered impact on Intel. But here's the thing. They will catch it on the other side as well, right? So if demand picks up, then retailers will want to make sure that they have product available to meet the demand. So they're going to build up their inventory levels as well. So, you could catch an opportunity here where people are pricing this thing way lower than it necessarily needs to go, and you could potentially pick up an opportunity here. And just moving into the data center segment, you can see that they got lower revenue in their, I guess this is their server segment, right? On total addressable market contraction and competitive pressure. So this is the area that I just didn't think that I would see. So the overall market is slowing as companies are rolling back server spend or CapEx spend, which is totally understandable in this environment. But the read-through is that in a more competitive environment, they may be losing their lunch or having AMD and NVIDIA eat their lunch in this space. And so this has been my worry for this from the beginning, is that, when there's a rising tide, it's going to lift all boats, and Intel will have revenue to gain by entering this segment. However, when the market stabilizes, like the server market, or if it contracts, it looks like as it is contracting right now, how much competitive does Intel have in this space? And, are they going to potentially lose out on opportunities as a result of their competitors? And so I want to learn more about this, because this is not something that I expected anyone to disclose in the server market that has been growing at double digits year over year for a while now, and I expect it to grow in double digits into the future as we sort of move into this like Web 3.0 space and this AI based space. Now, once again, guys, I am going to be updating the model, and I'll let you guys know who have access to the Patreon sort of like messaging system that I message you guys with. So I'll let you know once the model is up to date, and I'll just take a position on growth, etc. But the other thing that I'm going to do is tomorrow morning, I'm going to be paying attention to how this thing opens up, and I'm going to be looking at the cash secured puts, because some people might actually start giving us pricing that's absolutely stupid, and it might create an interesting opportunity, even for someone like myself who's not really a super bull on Intel. Hey, you know, as Benjamin Graham says, every company is worth buying at a particular price, and if somebody's going to offer me something horrendous here, I'll take a sort of like speculative position in this situation. And so we'll see how it plays out, but I will let you guys in the Patreon know. I mean, this is not a buy or a sell alert. It's none of that stuff. It's just me giving you an idea of sort of like what I'm seeing in the market and what those pricing relationships mean using the cash secured put calculator that I give to you guys for free, which you can access to in the description below. I know some of you guys are going to ask me about this, so I'll just mention it right now. It looks like they have lengthened the useful life of some equipment from 5 to 8 years, which of course is expected to boost up the 2023 gross profit by 2.6 billion, because it effectively brings down the amortization amount for 2023. And you know, this is something that I've done in the past as well, and it looks like this is industry standard. So you know, as a former Big Four auditor and someone who's worked in industry who's dealt with this equation, I guess, call it the useful life equation, I don't think it raises any red flags, considering that it seems to be industry standard. This you know, this equipment just seems to be lasting longer than it has previously lasted for. And so you know, I'm okay with this, but you know, if you continue seeing the industry do this kind of stuff, I'll raise more of a red flag on it, but right now it doesn't seem like anything. And so I'll leave it there for the first look. You guys let me know what you see. Are you a bull of Intel? Are you a bear of Intel? Are you looking to see how this thing plays out? What is your valuation on Intel as well? And so let me know in the comments below. Also, Microsoft just recently reported, and in Microsoft's report, I totally read through that there was going to be weak results for Intel as a result of Microsoft telling us that their client or their consumer segment was weak. And so if you've missed that video, you can get access to it right here.